What's up, YouTube? Welcome back to another video. In this video, we're going to be talking about liquidity, right? So liquidity is the most important thing when it comes to institutional trading, smart money, and Wyckoff in general, because liquidity is what really creates institutional trading and Wyckoff and everything like that. Now, liquidity was one of the first videos I made on the channel, right? I was covering liquidity, but I'm gonna redo it again, right? And I'm gonna cover it more, and we're gonna talk about it more, and just to kind of like revise it, just to revise it for people that didn't see the video or people that still don't understand liquidity. All right, so liquidity can be used in multiple ways, right? We could take liquidity, right? We could take out these people that are buying here and get all the money that's here, or we could use liquidity to drive the market towards a certain place, right? Because above each high, there is some type of liquidity, right? There's somebody selling, there's somebody buying under each low, there's somebody selling at each high, right? So there's liquidity everywhere in the market. Now you have to identify where is the most liquidity at in the market, right? Because each high has liquidity, right? But we're not gonna sit here and just mark out each high, right? So what we need to do is identify which is the key areas of liquidity, right? What are the key areas? The most common setup that you'll see when using liquidity is Asian session manipulation, right? So usually Asian session will consolidate, just like right there. You see this right here? This is all Asian session. So right here, this whole concept right here is one of the most common setups that, it's just the easiest setup to trade, right? So you're going to have Asian session consolidate, right? Asian session is going to consolidate. Boom. London's going to open, right? This is like pre-London, Frankfurt, right? It's going to open, manipulate, right? We're going to take out all these people that's buying here, all these people that's selling up here, right? Then the market's going to drive towards the way that they really want to go, right? So after that, guess what? You just open on the mitigation right here. So this is where the sponsor candle comes in and the order blocks. Really, these sponsor candles are evidence that the institutions bought here or sold here, because usually what's going on here, so the act of taking liquidity, right? This is exactly what happens, guys. Institutions dump money all right here to sell the market down, right? They dump money to sell the market towards the downside. Why? To get orders filled, right? This is liquidity for them to get their orders filled, because in Forex, right, for every buyer there is a seller. Okay, for every buyer there is a seller. So this is why they induce buyers. They need people to buy this, right? They need people to buy this so they can what? They can sell, and then they're gonna buy, right? So what they're gonna do is they're gonna take out everyone that's buying here, all right? And it's not just regular people like you and me. It could be other institutions as well, other smaller institutions, other smaller banks, right? These big banks, they're not just competing against us. We can't compete, guys. We don't have enough money to compete with these guys, right? So they're taking out people that are buying here. Why? Because they need them orders in the market. They need the orders. So once they have the orders in the market, then their orders can get filled, right? They need that liquidity so their orders can get filled. Okay, so they have to sell the market, and then they're gonna buy it all right here at this low price, and that's when you're gonna see that huge buy towards the upside. Why do they come back down? So they can mitigate this. Remember, they had to sell and to buy at the same time. They can't just sell, close, and then buy, right? Like we can do, right? They can't do that. So when they do this sell to buy, these sells right here are in drawdown. So they come back, mitigate the sells, go towards the upside. Now right here, we left liquidity here. Okay, now liquidity can be left in the market, and I will show you evidence of that as well, because the market will usually leave liquidity to target at a later purpose, right? Don't think just because you see liquidity, the institutions have to take it right away. Usually when you see there's liquidity and the institutions do not take the liquidity, that means they don't need the liquidity, right? They only use liquidity when they need to get their orders filled. Okay, so if they're not taking the liquidity or using the liquidity in some type of way, they don't need to use it, right? They already have enough orders, right? They already have enough liquidity already in orders for them to fill their orders. Okay, I hope that ain't confusing, guys. Okay, so liquidity is used for the banks and institutions to fill their orders. Okay. Oh, and I forgot to say this, but if you guys are interested in joining the Discord, right, link in the description. I have some more links in there. If you want a one-on-one session, you contact me. You can contact me on Telegram, contact me on Instagram, right, or anything like that. I forgot to mention all of those. I don't know. I am looking to do another giveaway. I don't know like when I'm going to do it, but I am looking to do another giveaway. Just to let you guys know. All right, guys. So a clear example right here is EU. All this is a big buy to sell. Accumulate, right? Accumulate, buy, liquidity, money, take everyone out, sell. I mean, it's clear as day, guys. You're seeing it's clear as day. Okay, so you have to understand how to use liquidity, right? You have to. So best way to understand this, right? This is what you could do. When you see the market accumulating, you have to ask yourself, why is the market accumulating, right? Why are we doing this? So before the market even went towards the upside, there's proof and evidence that the market is going towards up. So this is how you use liquidity, right? Usually I use liquidity as targets, but you can also use liquidity as in other ways as well. Okay, but most of the time it's going to be as a target, because most of the time market is going to go towards liquidity, right? Market attracts liquidity, supply, and demand. Okay, so before the market even went towards the upside, let's say you was right here. Where do you think the market's going to go? I know some people think, okay, there's an order block right here. There's no order block right here. This is no order block. The market didn't do anything. We haven't done anything here. All we did was leave highs, right? You see how all these highs are maintaining? This is a creation of liquidity. They purposely made this liquidity here. Why? To accumulate, take it, and do exactly what they just did. So what you have to understand is liquidity is created purposely. Okay, it's not something random that just happened, and it's not something fake, right? It's not just highs and lows. It's not something fake. This is real stuff right here. You're going to see this, right? Go in the market's back test. You're going to see this stuff. If you wake up during like London or New York, first thing I tell you to look for is look for this type of setup. Okay, look for Asian lows. You're usually going to see Asian create some type of liquidity, create some type of range or whatever, right? Here's the evidence right here. Let's see. You have liquidity. What does the market does? Takes liquidity, pushes to the upside. Now you barely got a test right here. Market took off, right? Even then, look where we came back to test. This area. You see what I'm saying? So this area right here is now creating a demand zone, right? So the purpose that we had in this area was to take this liquidity and drive it to the upside, right? So now that the market comes back down, where is it most likely to react off? The area that they know the market's sold to buy, okay? So liquidity basically just starts and gives you that evidence of the banks, okay? That's basically what it does. It gives you the evidence of the banks, because this is how they create the evidence with liquidity, okay? I can show you another example real quick. Yeah, I can show you AD CAD. Yeah, I can show you AD CAD. Guys, if this is not clear as day, I don't know what is. If this is not clear as day, I don't know what is. Well, I don't know about this, but don't worry about that. All right, hopefully it goes up. But if it's not clear as day, I don't know what is clear as day. Okay, we're gonna start from here, right? What do we have? We have equal highs, right? A creation of liquidity. Before the market goes down, what is this? A buy to sell. The market. So essentially the banks buy the market, right? They buy the market to take out these sellers, right? Then the market sells. Where do we come back to? The same area. And guess what happens inside this area? A distribution. Okay? A distribution. They're placing more sell orders here. What does the market do? Create a new low. And look what we do to go back towards the upside to test this area. We accumulate, right? And it looks exactly how we said it would look, right? Lows being created. All these lows are being created for liquidation, right? All of these right here is money. All these lows are money that they're creating, They're inducing people to buy. Why? So they can do this. Take all of them out. Take all of them out. Where do you get your mitigation? You get your mitigation right here. You get another mitigation right here. When the market takes off, you have a reaccumulation to get up to here. Once we get up to here and we do what we need to do, we test what we need to test, the market's gonna fall down. Now I was expecting for us to come a little higher. Now that bias has changed, right? So I'm gonna be looking for a new area. So that's basically what happens here. This is how the market moves, right? It's a cycle, guys. It's a cycle. Accumulation, reaccumulation, distribution, redistribution, right? Cycle, okay? If you didn't take anything from, like, if one thing I would tell you to focus on on this video is this setup that I'm showing you right now. Pay attention. This is like one of the best, like, this is one of the most common, easiest setups you can catch, guys. Just pay attention to this one setup that I'm showing you guys. Okay? It's gonna happen. It's not gonna, I'm not saying it's gonna happen every time or it's gonna happen every day, but look for it. It happens most of the time. It's common. It's a common thing that happens, right? Most of the time, Asian session is gonna get rated. Okay. You have what? Asian session. You have Asian. So I'm gonna just use this box. This is all Asian session. London comes in. We do what? We take out all of this liquidity. Everyone that was buying here, we take them out, and then we move towards the upside. Where does the market come back to test? Let me draw this out. And I'm gonna show you the exact same thing happened again, guys. It's like, look at this. So we rated this liquidity, we're going to the upside. This area becomes now a demand zone. The market comes back to the demand zone and does the exact same thing. Create liquidity. I'm going to go to the 15-minute for you guys. Create liquidity. This is all Asian. All of this right here is Asian. London comes in, raids the lows. We fly to the upside. You see what I'm talking about? Easy. This is an easy setup, guys. Easy. Just look out for this. Look for the London. Not just look for the Asian, right? Always identify what is Asian doing. Is Asian ranging? What does Asian look like? If you see Asian ranging, most likely than not, you're gonna see London session manipulated, whether it's toward the upside or to the downside. Look to see where London session manipulated. They're usually gonna go the opposite way, right? Because when they create that manipulation, they want people to think that they're gonna go that way. So basically what they did is they wanted people to think they're gonna sell. So even the people that was selling up here with them still got taken out, right? So use liquidity, right? Always look for where is the liquidity of the market? Where is the money? That's what you really want to focus on. Where is the money? Okay. So with this, guys, now your targets are going to be better, right? Why? Because you're targeting actual areas that you know the market will reach. Okay, don't target just a random high or a random low. Target the liquidity. Target where is the money? Where do these banks want to go to? What is their target? What are they looking to do? Okay, that's what you want to focus on when using these targets. And this is why people have the confidence. When you see some people holding trades for like a super long time, or you see people swing trading, they have the confidence that they know the market is going to go to where they put their TP at, because they know, right? They have studied. They didn't know that the banks actually want to reach that area. You don't just set your TP at a random area, right? You don't just set your TP at a random high or low, right? You want to have confluence and you want to have evidence, right? You want to know that the market's actually going to reach that area. Okay, so this is a simple video on liquidity, right? I hope I didn't overdo it, guys. If you want more insight on this stuff, okay, join the Discord. I have a full mentorship on there. We do one-on-one sessions if you need it, okay? So just contact me, let me know, and I'll see you guys in the next one.